Every year, millions of Canadians hand over more money to the CRA than they actually need to. And here's the thing, it's not because they're doing anything wrong. It's because they're not doing anything strategic. They contribute to their RSPs without thinking long term, they sell investments without planning for capital gains, they retire without a clear withdrawal strategy, and they assume their accountant or tax software will figure it out. But taxes aren't just something you file once a year. They're something you can plan for every year. And when you do, you don't just lower your tax bill, you unlock more cash flow, protect your wealth, and create more financial freedom. So if you're a Canadian looking to reduce taxes legally, efficiently, and without complicated loopholes, this video is for you. Because tax planning isn't just for the ultra wealthy, it's for anyone who's ready to start keeping more of what they earn. Hi, if you're new here, my name is Stefano Francescut, and I'm a certified financial planner professional at Next Step Wealth Management with IPC Securities Corporation. For over 30 years, I've been helping Canadians build personalized financial plans that grow their wealth, protect their income, and reduce unnecessary taxes, especially as they approach retirement or manage a growing business. And today, we're diving into one of the most powerful tools available to every Canadian, strategic tax planning. So let's get into it. Part 1, understand your tax brackets and why marginal tax rates matter. One of the most common misconceptions I see, even among high income earners, is not truly appreciating how Canada's marginal tax system works. And let's be clear, this isn't just a technical detail, it's the foundation for every other tax planning strategy. First, what is a marginal tax system? In Canada, we don't pay one flat tax rate. Instead, our income is taxed in tiers or brackets, and each additional dollar of income you earn gets you closer to that next bracket. Let's use an example for Alberta for 2025, rounded for simplicity. The first $57,000 you earn is taxed at about 23%. The next $58,000 is taxed at about 30.5%. Income between $115,000 and $360,000 gets taxed anywhere from 36 to 47%, and once you're earning over $360,000 or so, you're looking at 48%. This means the last dollar you earn is taxed at your marginal rate, and that's the rate that matters most when planning your income, withdrawals, contributions, and even investment sales. Why does this matter for tax planning? Because smart tax planning is all about timing and income smoothing. It's about asking, should I take this income now or later? Should I contribute to my RSP this year or wait until I'm in a higher tax bracket? Should I sell this investment now or defer the capital gain until retirement? Each of these decisions becomes far more strategic when you understand how close you are to the next bracket and what impact that extra income might have. Example, two taxpayers, same income, different results. Let's say two people both earn $100,000 in total income, but one of them also sells some non-registered investments and realizes a $50,000 capital gain in the same year. Because capital gains are 50% taxable, $25,000 gets added to the taxable income, pushing them up a bracket and potentially triggering higher marginal tax rate on their income, a clawback of government benefits like Old-Age Security, increased surtaxes on some provinces, and a larger tax bill overall. Had they spread out that gain or timed it in a lower income year, they could have saved thousands, simply by understanding how their marginal rate affects each decision. Planning around brackets equals powerful control. Once you grasp how marginal rates work, you can start to stack income in lower tax years, like early retirement or business transitions, defer income in high tax years, split income across family members to stay under key thresholds, use vehicles like TFSAs to generate income without raising your tax bill or tax at all, avoid surprises like OAS clawbacks or jumping into a new tax bracket with poor timing. This is why I always start my planning conversations with clients by mapping out their tax brackets today and where we expect them to be tomorrow, because that clarity unlocks the strategies we'll use in every other part of their plan, from investments to retirement income to estate taxes. Part 2, don't just defer tax, spread it out over time. When it comes to tax planning, most Canadians are taught one golden rule: defer tax for as long as possible. And while that advice works in some cases, it's not always the most strategic, especially if deferring pushes you into a higher tax bracket later in life. In fact, for many professionals and business owners, paying a little tax now can be far better than paying a lot more later. Let me explain. Tax deferral isn't always the best option. Let's say you're in your early 60s, retired from your main career, and not yet taking CPP or OAS. Your income is temporarily low, maybe $20,000 to $30,000 per year from part-time work or investments. You might be tempted to delay RSP conversion to a RRIF until age 71, when it becomes mandatory. After all, who wants to pay tax now? But here's the problem. When you convert your RSP to a RRIF, the government forces you to withdraw a minimum percentage every year, whether you need the money or not. Let's say your RRIF is $1 million at age 71. Your minimum withdrawal would be roughly $53,000 that year, and it grows every year after that. Now add CPP, OAS, and maybe some investment income, and suddenly you're earning $80,000 plus a year in retirement and paying much more tax than necessary. Instead, withdraw strategically in low-income years. If you had taken $20,000 to $30,000 per year out of your RSP in your 60s, when your income and tax rate were lower, you could stay within the lower tax brackets, reduce the size of your future RRIF and those forced withdrawals, avoid triggering the OAS clawback, and convert that money into TFSA contributions, which grow tax-free and don't affect income-tested benefits. This concept is called income smoothing, and it's one of the most overlooked tax planning opportunities for Canadians heading into retirement. Here's an example: RSP withdrawals versus future tax burden. Let's say you withdraw $30,000 from your RSP at age 60. If your other income is low, depending upon your province, you might pay around 20% on that amount. That's $6,000 in tax, leaving you with $24,000. Now let's say you wait until age 72 and that same $30,000 is withdrawn on top of all your other income sources, pushing you into a 30% marginal tax bracket. That same $30,000 could now cost you $9,000 in tax, 50% more. Multiply that over years of retirement withdrawals, and we're talking tens of thousands in lost after-tax income. Bonus example: converting RSP to RRIF before age 71. Did you know that you don't have to wait until 71 to convert your RSP into a RRIF? In fact, you can open a RRIF at any age and begin withdrawals, giving you access to pension income splitting, as well as the $2,000 pension income tax credit starting at age 65, and more control over when and how you withdraw your savings. This can be especially powerful if you're semi-retired, self-employed, or transitioning between income phases. Deferring tax only makes sense if your future tax rate is going to be lower. But for many Canadians, especially those with large RSP accounts, investment portfolios, or multiple income sources, that may not be the case. Strategically spreading withdrawals across time lets you pay tax at lower rates, preserve your government benefits, create more tax-efficient income in retirement, and avoid large lump sum withdrawals that push you into higher tax brackets. Tax planning isn't about avoiding tax entirely. It's about paying the least amount possible over the longest period of time. Part 3, income splitting, the quiet power move. If you're married or common law, income splitting is one of the most overlooked and powerful tools available to you. Here are 3 ways Canadians use it: pension income splitting, up to 50% of eligible pension income beginning at age 55, or RRIF income beginning at age 65, can be shifted to a lower income spouse. Spousal RSPs. A higher income spouse contributes, a lower income spouse withdrawals in retirement, spreading the tax burden. Using a prescribed rate loan. Lend money to a spouse at CRA's low prescribed rate, currently 4%, and invest the proceeds in the lower income spouse's name. This can shift thousands of dollars of investment income annually. Income splitting isn't about loopholes. It's about leveraging the household as a team. Part 4, don't let capital gains catch you off guard. Capital gains are only 50% taxable, making them one of the most efficient income sources. But they need to be managed carefully, especially after recent proposed rule changes. Smart investors plan the timing of gains. Example, sell in a lower income year. They use tax loss harvesting to offset gains with losses from other investments. They use corporate class mutual funds or T-SWIPs in non-registered accounts to manage the timing of taxation or tax-preferred return of income. If you're planning a large sale, like a rental property or business, be aware of what tax bracket it pushes you into. That one transaction could cost you tens of thousands in unnecessary tax without using the right planning. Part 5, use your corporation wisely if you're a business owner. Business owners have extra flexibility, and that flexibility can turn into tax savings when managed well. A few key strategies I often explore with clients. Firstly, maximize the small business deduction for corporate income. Avoid having associations with other businesses or passive income that can grind down the small business tax rate. Second, use a holding company to separate investments from active income, protecting assets and potentially deferring tax. Consider optimizing paying dividends versus salary based on your RSP, CPP needs, and long-term planning goals. Also, split income with adult children or a spouse where appropriate and compliant under the TOSI rules. Working with your tax advisor, we help clients align their personal and corporate income planning so the left and the right hand are working together. Paying less tax in Canada isn't about hiding money or finding loopholes. It's about understanding how the system works and aligning your strategy with your goals. Most people don't need more complexity. They need clarity, coordination, and consistent advice. If you're a Canadian business owner, professional, or retiree looking for a smarter tax strategy that fits your life, click the link in the description to book a discovery call with me or my team. We'll review your numbers, answer your questions, and help you create a plan that lets you keep more of what you earn and feel comfortable about the road ahead. Thanks for watching. We'll see you soon.